So this is specifically for, it's a beginner's course, but it is very much important because there might be something that um, you and I may both learn because, at the time where most of us started trading, like personally, I came to go back to understand that I needed to learn the foundation about Forex. So this is a Forex trading beginner's guide, and I welcome you all to join. As you can see, it's a presentation that is going to cover the essential aspects of Forex trading to help you get started on the right foot. So we are going to discuss the most crucial concept to set a solid foundation for the journey of trading. So this is also going to act as a refresher lesson to both you and I, because even me, I'm revisiting this. It has been long since I also taught this, and since I also had the opportunity to go back and start doing a refresher lesson regarding this. So I'll be taking you through. I'm pretty sure you know me. This is Wisdom, okay, and I am your tutor today. So let's proceed. This is an introductory part. So what exactly is Forex? Please, I'm also recording this. So what I'm going to do, I had a discussion. I even told my sister Doris to say, okay, so what to be doing each time we are having a lesson, we'll be posting and sharing it on YouTube, put on a private, and then only those with the links will be able to have that access in order to watch this video, since I saw that there is need for everyone to have access to the recorded videos of the sessions that we are having, since I saw the trouble that my sister was going through and the screenshot that she sent, she was unable to watch on our phone. So if we put the videos on YouTube, it'll be very much easy for us to revisit and also to just give somebody the link, especially a video when it comes to Forex trading, a beginner's guide like this one. We can just record it and then we're just giving them a link. So what is Forex trading? Forex involves the buying and selling currencies in the foreign exchange market. All right. And it is the largest and most liquid financial market globally, with trillions of dollars traded daily. So you discover that the other term for Forex trading is the buying and selling of currency. You buy one currency by selling another. So let me give you an example for this one. Let's say you have USD. Sorry, I'm using my trackpad. So let's say this is USD and then this is Euro. All right, you have Euro this side and you have USD this side. Now what happens is that since you are having dollars, all right, you have to sell these dollars by converting or exchanging it for Euro. So what simply means this here is that you are doing a transaction of selling and buying at the same time. This is the only business where you can do two things at once. You are selling and buying at the same time. And you will sell with the perspective or with the mindset of making money, and also buying with the mindset of making money in the future. So let's say you've seen that the certain currency has reached at the peak level where you have to sell, and you have noticed that it cannot keep pushing there. It can drop anytime, and hence I can lose out. So you say, I am going to sell at this level. All right. So if you are trading Euro USD, you see, okay, Euro is going to be buying. So you buy Euro by selling your dollars. So you have sold your dollars by buying Euro. Okay. It is the two-way thing. And doing this, it is also like, for instance, I am a Zambian. My sister Doris is from Kenya. And then what I'm doing is that, okay, I come to Kenya. And then if I come to Kenya, what I'm going to do now is that I cannot do any transaction using my kwacha, Zambian kwacha. So what I'm supposed to do now is to exchange my kwacha by buying Kenyan currency or Kenyan shilling, if I'm not mistaken. And while at the same time doing that, it is also like you have bought some part of shares in that particular country by buying or participating in that currency exchange. Okay, in this regard, what we are trying to say is that when you exchange one currency for another, it's like now you have bought some shares in that particular country with a view, of course, of making some money, especially to the part of us Forex traders like you and I. It is also simple, like trading, Forex trading is a broad term. You also, let's say, if you are a stock trader, you've seen that Nasdaq is at a very powerful level where you expect a buy. And then once you buy there, let's say you have bought your shares, for example, at $1, and then you have used that $1 to purchase at least, let's say, 5 shares. That means you have invested about $10. And then the market moves, all right, 20 or 2,000 points, which is 200. Okay, and if that is what is happening, you are going to discover that the market is no longer going to give you, or you're not longer going to have the same amount of money that you had. Let's say you had invested or put in your account about $100, and then you see that there is an opportunity for you to trade and invest by buying shares in Nasdaq. And each share right now, for instance, it is going at $1. And then you have bought 10 shares, which will cost you about $10, with the remaining margin of about $90. And then the market pushes about 200 points, okay, which is 20 pips, or 2,000 points, which is 200 pips, okay. And each movement you're making, let's say you're making $1. So at the same time, you're no longer going to have $100, you're going to have about $500, because you bought 10 shares, all right, and 10 shares, each share is going at $1. So 10 shares, and then the market moves 200 points. So that is equivalent to, each share is giving you 100. Each share is giving you 100. That is equivalent to $2,000. Sorry, my mistake. $2,000, not 500. All right. Plus the already amount of money that you had put on. So in simple terms, Forex is the buying and selling of foreign exchange or foreign currency for another. You buy one currency by selling another. It is a simultaneous buying and selling. Now, here let's look at currency pair. In Forex trading, it involves currency pairs such as Euro USD or Euro versus dollar. When you buy a currency pair, you are essentially buying the best currency and selling the quote currency. So let me explain this. Here we have Euro, which is the best currency, and we have USD, which is the quote currency. So in simple terms, if you are looking, or you look at the your chart where there are list of currencies, you discover that there is going to be Euro USD, GBP USD. Any currency pair that is on your left hand side, like this Euro, it's called a base currency. Okay, it is called a base currency. All right, I can say, Mr. Makasa, okay, I've allowed, although I've also recorded this one, so we are going to put this on YouTube so that people can have access to this lesson. So you have done well as well. So Euro is a base currency, USD is a quote currency. Okay, so what happens is that if you have Euro USD, let's say you say sell Euro USD, we are we are trying to say you have sold, you are selling Euro by buying USD. Let me make sense. Let me make this clear. Let's go on TradingView. This is TradingView.com. Now, if you look at TradingView, you discover that we have GBP USD. So if we say buy GBP USD, we are saying that we sell USD by buying in GBP USD, okay, by buying GBP. So what happens is that, let me give you an example. These candles that you're looking at, there is green showing a momentum up and there is red showing the momentum down. It simply means that each of these color candles, they are representing each currency, because there are two currencies and also there are two types of candles. We have bullish candlesticks and we have also bearish candlesticks. So here, these candles, they help us to visualize, or they give us an aid by giving us the visual representation of what is happening on the market. So here you can see that the green candle here, it is able to tell us the history that GBP, which is this one, okay, this one, GBP, or Great Britain pound, appreciated in value by moving, reaching to that level. And then these red candles are representing USD. We can see that USD, or United States dollar, did also appreciate. Now you may say, how come, hey Wisdom, but how come you're saying it appreciated in value when initially it was dropping? Because if GBP USD, we see the market rising, it is rising, showing us that Great Britain pound is appreciating in value. And this market year dropped. What dropped in price value is GBP, and USD was the one appreciating. Let me ask, is this making sense? It's making sense, right?
Yeah, it's making sense.
Okay. So what we are saying is that these candles, there are two types, the one that are pushing up and the one that are pushing down. So the one that are pushing down are representing the court currency. The one that are pushing up are representing the best currency. In simple terms, we can put it that way. Okay, so we move into the next one. So let's try to look at the important and also the benefits of trading the Forex market. Okay, number one, the Forex market works 24/7. Okay, it operates 24 hours a day, 5 days a week, making it accessible to traders worldwide at any time. So now, right now, as I'm talking to you, we are in what we call New York session, which started around 14:30 Central African time. Because if it is 14:30, like here in Zambia, in America, that is 8:30, the market opens. So with this one, you can say, oh my God, I missed that. You cannot miss, because you're still going to trade. From 9:30 a.m. Zambian time, that is when London session opens there. To them, it is 8:30 a.m. And then it will close. So it overlaps. The moment London is closing, New York is taking over. That means the market never sleeps, and the transactions will continue to move on, with trillions of dollars being traded every day as the daily volume. So there are types of market participants in the Forex market. Okay, various participants drive the market Forex, the Forex market, including retail traders, banks, institutions, and central banks. So us, you and I, we are retail traders. And then we have, in rank, we have now banks. It can be like First FNB. These, they also participate. Let me tell you this, guys. Do you know that even these banks like FNB, Barclays Bank, all these small Zanaco, all these small banks, they also trade Forex. They have specific traders who work for them, who trade for them. Okay, not necessarily the Forex where we go, we take that is also Forex, but they also do trade Forex just like you and I. That is also how they make money. And at times, they will also use the same money that you and I take there in order to deposit in a fixed account. And after some time, we can now have access to that money with an interest on top. They will use that money, multiply it, and then give us a peanut over them making more money using our money trading Forex. Okay. And then thirdly, it is also important for us to understand bid and ask price. The bid price is the price at which a trader can sell a currency. So a bid price is a price at which a trader can sell a currency, while the ask price is the price at which they can buy. So sometimes you may say, okay, guys, we are going, what is the ask price? In simple terms, let me show you here. In simple terms, we are saying, if we say that what is the ask price, we are trying to say that at what price. So let's say this is GBP USD. The numbers to my right hand side here, these are prices. So the ask price right now where the market closed on British pound USD is 1.25756 in red. That is the price. So if we say I'm going to buy GBP USD at the ask price of 1.25756, we are meaning the price where we can buy. And then what is the bid price? It is the price, for instance, here where we are saying we are going to sell at this price, which is 1.26893. That is the ask price. In simple terms, it is like you're doing a deal with somebody, and then you tell them, okay, what is the starting price? Okay, so the starting price of selling something is also same as the ask price that we use. These are the terms that we use in Forex trading. And then the bid price is the price at which the buyer is willing. Okay, the ask price is the price at which the buyer is willing to buy from the seller. And then the bid price, it is the price at which the seller is willing to sell. So it's like they're bidding. Okay, so that is what it means. Okay, so let's proceed. Now, what are some of the key concepts and terms that are important for us to understand when it comes to trading? Okay, this is very, very much important. In fact, on this topic, it is very much good that even every one of us are here, and because these terms, they are going to help us. This is what the problem is to most beginner, intermediate, and also those who have taken long since they learned Forex. They have been in trading Forex for years and years and years, and yet they are not consistent when it comes to making money on the Forex market. Then what could be the problem? The problem is in misunderstanding the concepts. So the first one, I want us to look at the concept called pips. What are pips? This is very, very much important because everything here determines how good you are at risk to reward ratio. And also everything here determines your profitability and consistency as a trader. So let's first try to understand pips. What are pips? The short the pip stands for points in percentage. Points in percentage. So you discover, I even said something earlier on that, let's say I say, okay, 2,000 points. If we convert that into pips, it is going to give us 200 pips. So there is a difference between points and pips. So if we say 100 points, okay, we are saying 10 pips. If we say 200 points, we are saying 20 pips. If we say 2,000 points, we are saying 200. So that's the reason why they call them points in percentage, because these represent the smallest units of price movement in the Forex trading. They are crucial for calculating profits and losses. So let me give you an example. Okay, the market moves 10 pips. I want to explain what they mean by profits and losses. The market moves 10 pips from here to there. And then you used your lot size, this second point, okay? You used a lot size of 1.0. Pardon me, I'm not using my pen. I'm just using my trackpad. So 1.00. So any number, okay, let's say you go on your MT5 or MT5 or MT4, you try to insert a lot size. So any number before the point is called a standard lot size. So standard lot size, if you're trading currencies, let's say you put one standard lot size, you are trying to say you'll be making or trading and participating into the Forex market with the units of currency, because Forex calculator will never understand you if you try to use numbers as in price like $10, $1. No, it understands what we call units of currency. This is the reason why they are saying pips or percentage in point or point in percentage. That's what pips is. So let's say you say, okay, you want to open one standard lot size. Now, that one standard lot size in units of currency, it is known as 100,000 units of currency. So when you punch in one standard lot size in your MT4, the program or the algorithm behind the same of MT4 or MT5 will do the calculations for you. So it won't just take in the initial of one standard lot size. It will take that 1.00 and convert it into units of currency. That means you're participating in the Forex market with 100,000 worth units of currency, which is one standard lot size. And then now, let's get back to some basics. If the market moves 10 pips towards the direction of your analysis, and you used one standard lot size, you will be making $10 per pip. So one standard lot size is equals to $10 per pip if you're trading currencies. One standard lot size, if you're trading gold or NASDAQ, it is going to be different because those are big and they're volatile, like no man's business. So if it comes to currencies, you say, okay, one standard lot size, you're initially saying, I will be making or losing $10 per pip. So if we come back again to this point, it says point in percentage represent the smallest unit. That is the reason why just a small fluctuation where the market just moved a little bit, you're going to see to be negative or in losses, because those are pips and you can't even notice that these are how many pips unless you try to use pip measurement on your MT5 or MT4 or trading view. Okay, now let me give you an example on the same topic. If I take you on trading view where I want to demonstrate something about what I've just explained, let's say that you want to buy GBP, okay? You want to buy GBP right here. So you are going to say, you use this tool for long position to say, I'll enter here. And then let's try now to reduce the pips, the stop loss. Okay, let's say you use 30 stop loss, 30 pips stop loss. And then your target is 93 pips. Your risk to reward ratio is 3. It means your profit, if the market reaches that target, you're going to make 3 times what you could have lost here. Now, imagine that you had opened a one standard lot size, and then the market hit your stop loss. You're going to lose $300. And if it goes this way, you're going to make how much? That is $930, because you opened a one standard lot size where you're making $10 per pip. And then the market moves 93 pips. you have made how much? That is $930, and here you could have lost $3,300. Why? Because each pip, based on the calculations, you're making or losing $10. Now, let's get back here. If you look, pips and lot size, they are the same. They work hand in hand. Sorry, not the same. They work together. You cannot make profit without you having an understanding of this. So now let's try to explain about lot size. Lot size refer to the trading volume in the Forex. A standard lot is 100,000 units of the base currency. The size of your lot determines your potential profit or losses. So imagine you have an account of $100,000. You're trading a prop firm. And then you open a 10 standard lot size. You're trading currency. Initially, you're saying that 10 standard lot size is equivalent to 1 million units of currency, because if we convert that into how much you'll be making or losing per pip, it is $100 per pip. So if the market moves 10 pips, whereas you open a 10 standard lot size, which is 10.00, you'll be making $100 per pip. So these, they help us to understand the loss and the profit, the risk, good risk management, or an impulsive trader who just use big lot size with the mindset to make more money without even using proper risk management. Let's talk about the leverage. This is also important because, especially here, it is important that we understand this. So leverage, the leverage allows traders to control large position with a smaller amount of capital. It can amplify both profits and losses. So it is essential to use it in a responsible way. So let's say you have a $10 capital you're trading, okay? Now, this leverage, the leverage here will determine, okay? It will determine, this leverage here will determine how much lot size you can open using your $10. If your leverage is 1-to-1, you cannot trade on a $10 account. If your leverage is 1-to-3, you cannot trade on your $10 account. You need a big leverage. The simplest way to define a leverage is borrowed funds by the broker. Remember that if you have $100 with a leverage of 1 to 3,000, you can open a 1 standard lot size and make more money. If you have a $200 with a leverage of 1 to 300, you cannot open a 1 standard lot size. Maybe you can open a 0.1 or 0.01. So leverage is the borrowed fund. That's the reason why it says that it allows traders to control large position with smaller amount of capital. It can amplify both losses and the profits also, which simply means that if you want to know how much you can make and how, if you're a good risk manager or not, you have to understand all this. So for instance, how can you use and take advantage of a big leverage like 1 to 200 to 2,000, 1 to 3,000, or 1 to 1,000? I only use this big leverage if I'm trading news, but if I'm trading technical, I would prefer I go for 1 to 500 or 1 to 1,000 if it goes too far, because the leverage is going to give you that ability to open big lot size with a small capital. Now, just by any mere mistake, the market goes against you, you get wiped out and make losses. So pips, lot size, and leverage. The other term that I would love to define a leverage is an example. Let me give you this, an abstract. If you look at these big machines like an aeroplane, these big vehicles, trucks, abnormal loads, that thing is very much heavy. Yet the driver who operates those things, aeroplane, they don't feel any weight when they are driving or flying a plane. They use lever, okay, that small thing to lift a big thing. They use gear levers to move that abnormal trucks from point A to point B without them feeling the weight, because that is giving them the ability to control a huge weight using a small thing, which is a gear lever. And that gear lever is giving instructions to that engine in order to move that truck. So that is another. So in simple terms, it is where now the broker comes in, because way back the history was that trading was not for retail traders. It was only for rich people. And the minimum amount which was that was about $100 in order to participate in the Forex market. So they sat down, they said, okay, we need everyone on board to participate in the market, in trading. So they had to introduce now brokers. Instead of you and I to be making deals with central banks and banks, brokers come in as the middleman here. Here is a central bank, and this is you and me. So going direct to central bank, they will require us to have huge amount of money, because this is a big institution. So now brokers come in now. So brokers will get the actual price from central bank, bring it to their broker, and then present it to us. You and I will quote how much is dollar selling against euro, or kwacha against shilling. So they'll give us the actual price without missing. So this being the middleman, they will now need us to pay them what we call commissions, or in a spread. Okay, so guys, what is happening is that I'm using this a free version. So I want to end this session, and then I want you to reconnect back just now, because we only have about a minute to go. So that is what is all about this concept, people. So it is very, very much important for you to understand this area. This is going both to me and for those of you who have been trading, and also to those of you who are just beginning to trade. Understand this concept, because they determine the future destiny of you as a trader. And you cannot make money if you don't know how to use this. You cannot know how to make calculations if you don't know how to use this. This is why it is essential for you to know what you're doing, and also what to do and what not to do. A leverage can be used to trade and open big lot sizes. So you discover that a person just have $100, but they make $2,000, especially if they are trading news. Why? Leverage and also big lot size, and the market moves a lot, many pips. Imagine you open a 2 standard lot size and then the market moves 200 pips. You make $2,000 in a short span of time. So let's please rejoin again, because this is going to end, and then we will proceed and finish this up. So please join back again.